The big question that people have been asking is that, is a consumption revival, is consumption going to lead the charge in the next round? Is that where we are going to make our money? Because investment phase has sort of done the heavy lifting over the last, in the post-COVID period, especially because we were in an investment upcycle also triggered by huge spending by the government. Is that, in a sense, likely to get swapped in this phase? Shridatta.
Good evening, everyone. I think it's an interesting question. Most of the time we try to answer questions in black and white. My answer is in between, actually. It's going to be barbell. That's how we are looking at it. But having said this, on this barbell, I think both sides, whether it is investment side or consumption side, there are certain clear-cut trends that are visible. And as you rightly said, and I largely concur with that, that if you look at not only last actually 4 years, but if you take last 10 years, effectively, predominant focus both from central and state governments and then real estate joined the party, which are the three critical components of Capex, have been on the positive side. In fact, the growth in these three categories, if you take 5 years, has been upwards of 13-14% CAGR. Even if you take 10 years, it's actually roughly 10-11%, which is a little bit higher than nominal GDP growth rate. And that clearly propelled the kind of rally that you have seen on the investment side, because to start with, they had gone through the underperformance of the entire last decade, because balance sheet, we started the last decade with leverage. And that's where there were a lot of challenges, both on banking and manufacturing side. And as you came out of that, you got both the earnings re-rating, driven by all three components. And in fact, private Capex was also healthy for 2 years, calendar year 22 and 23 particularly. All four components were firing. And so you got a growth which was clearly above average. Now, having said this, does it mean that you're likely to see a substantial slowdown? Our sense is it is just going to be moderation. And incrementally on investment side, clearly you have to actually opt for pockets where either for geopolitical reason, which is some of the defense, aerospace, and some of the areas where probably opportunities will continue to expand. So you have to continue to look at them, not necessarily the same stocks, same spaces, but that one you have to continue to look at. Clearly transmission and distribution is a space which you have to continue to look at, given how the power sector dynamics is changing. You would also continue to look at renewable power itself. Now you can choose, pick and choose the part of the value chain that you want to play, but you have to continue to look at. So incrementally, yes, the margin of safety on the investment side has gone down. Incrementally, there is a moderation, except for private Capex, which we are expecting that at some point in time will kick in. But clearly, public Capex has kind of plateaued, mostly probably run at 8 to 10% CAGR over next 2-3 years. And when I look at all these three things, on the investment side, clearly we would want to be placed in a space where the profit pools are expanding and there is a high visibility. And those are the three spaces where I clearly see that, okay, both these criteria are getting met. So that's the investment part. When I actually start looking at the consumption side, I think clearly when you again look at what are the key drivers for consumption, actually the key two drivers for consumption fundamentally are, of course, one is job growth rate, wage growth, and third is whether we like it or not, again, Indian basically economy is structured in such a way that again governments play a very, very critical role. I'll again step back and say, when you look at the revenue expenditure of state central government put together versus the capital expenditure of state central government put together, this regime over last 10 years has chosen predominantly the investment side or fixing the supply side versus the consumption side. And that's where the revenue expenditure generally has been lower, which has also been one of the factors apart from subpar job growth, which has led to mass consumption. Again, when we talk about consumption, it's the mass consumption which has suffered, not the luxury consumption. Our sense is incrementally the redistribution of government resources has started tweaking towards the basically mass consumption, towards the revenue expenditure. If I have to quote the few, the social schemes put together, state governments 3.2 lakh crore rupees, central government tax cut of effectively 1 lakh crore rupees. You have GST cess, which will go out, the obligation will go out in 2027, which will be available money for central government to spend towards consumption, the liquidity, the interest rate cuts. So when I actually combine, and wealth effect through gold, when I combine a lot of these factors, and when I look at the expectations on consumption side, particularly mass consumption, I'm again and again actually addressing that point. In terms of the statistical valuation might be a little expensive, but from an expectation perspective, from a margin of safety perspective, I think that piece, if one were to find the right niches, would probably give you better outcomes over 3 years. That's how we are looking at it. So that's a long answer to your short question.
Yeah.